Hello, everyone. This is Richard C. Wilson, founder of the commercialrealestate.com and the Family Office Club. And today I have with me my friend Ben Marks here. Welcome, Ben.
Hello. Thank you for having me.
Sure. And Ben is the head of Leverage Equity Holdings, a single family office that does investing. And he's been involved in the Family Office Club for the past several years and has spoken at some of our largest investor summits during that time. He's got a broad array of experience that we'll get into through this interview. We're going to go through about 20 questions on relatively quick style here, touching on a bunch of points. They're going to touch on his 30 years of experience and kind of share some of those insights, kind of like if you had a intense cup of coffee with Ben, then you could pick his brain on all these different questions. And so appreciate you being here. Anything you want to add, Ben, to your background that would help people listening to this today?
Thanks very much, Richard. Just single family office. We started Florida-based. We almost exclusively invest in commercial real estate and sort of peripheral related businesses, but we're primarily a commercial real estate outfit. My background is pretty heavy in economics and in capital markets with some Wall Street and finance experience. But that's you basically did a good job of hitting the broad strokes. Thank you.
All right, great. Yeah, and I know you've got a pretty good strength in the commercial real estate due diligence side of things, and it seems like that's been a strength when speaking on stage at our events in the past. So appreciate the help here today with the interview. All right. How are interest rates tied to property prices, and why do investors watch the Fed so closely on changes in rates?
Gotcha. So I think the first, it's a great question. And I think it's a good place to start. I think the first thing it's important for most folks, particularly who are looking to get into commercial real estate, especially if they are coming from another industry. Real estate is very unique in that it is almost entirely financed and structured based on debt. And so a typical multifamily deal, for example, where say there's 100% of the capital stack, 80% is financed typically by a lender, by a first mortgage. And then sometimes more. We've had a couple deals where that's higher, but typically 80% is fairly common. And then the other 20% is either a combination of equity, preferred equity, or some other type of structure. So getting back to your question, when you have 80% of anything being financed, based on interest rates, it's highly leveraged to interest rates. And that's why if you take a longer term view, back when I started in the late 90s, our first deals were getting financed at about 8.5%. Today, we just literally today locked in a new structured refinance that we're in the process of doing at 2.5%. So if you go from 8.5% to 2.5%, that's 600 basis points. What that really means is that it's cheaper to finance and that the same existing cash flows of a given piece of real estate are worth more because it's cheaper to finance. And so that's why the relationship between interest rates and prices are directly and almost exclusively inversely related, meaning as rates go up, values tend to go down.
Right. That makes a lot of sense. So in layman's terms, if rates start to go up, then the NOI is going to drop, the free cash flow will drop because you're going to be paying more to the bank to borrow that money. There'll be less profits available for the investor. So those things just, move in inverse directions, essentially, is what you're saying, right?
Correct. I'd say it's inversely related, and because so much of it is so often financed by debt, it literally, it's one of the most levered industries to interest rates that's out there.
Right. Okay. What insights can you share for those looking to start to invest in commercial real estate properties?
Wow, where to begin? I think, I'll start with this. I think especially for younger companies and younger folks going into the industry, and you'll see this as a running theme with, what we're doing in operations now. The industry, it's always changing, but I would say, especially post-COVID, the rate of acceleration and the rate of disruption within every asset class is really completely bifurcated. And when I say bifurcated, I mean, you can have similar asset classes in different parts of the country behaving differently. You can have different assets within a given city, in the same city, Miami, Florida, where we are. Multifamily has never been better. Office and retail, not so much. And so I think getting a handle and really deciding on where you want to specialize is probably more important now than it's ever been. Because up until a couple of years ago, if rates were down, every asset class went up. And conversely, if rates were up, every asset class went down. That's beginning to change, even though, per the prior question, interest rates are incredibly important, but almost as important now is really the nature of the asset, and whether it's disruptible. And I think that's becoming a key issue in how we're operating.
Right, great. Having worked with commercial real estate brokers, dozens or hundreds of times, what is your advice for getting started as a commercial real estate agent?
Yeah, so I think obviously understanding your asset class, or understanding your property type. If you're in residential, I'm a big fan of hyper specialization. If you're going to do exclusively single families on the water in Broward County, or in a given county, the realtors I've worked with that have had the most success are hyper laser focused on one asset class, sometimes even in a neighborhood. And I'm not suggesting everyone should do that. What I am suggesting is understand your asset class better than anyone else, number one. And then a very close second to that is learn to think like an owner. All the brokerage relationships that I have that are successful and long-term, I know for a fact when I get a phone call from an agent or a broker, they're going to think like I am, and they're not going to think like a broker. And I think more than anything, that's what, the pattern of the narrative I see in successful brokers.
That's a really great answer, right in line with what makes a powerful single family office. We have a single family office flying here on Saturday, and we're helping them specialize in a neighborhood in only one asset type. But more than that, for proactive reach out for off-market deal flow, we're identifying 2 city blocks that we just want to assemble a package on over time. And I think it's that exact type of mindset and approach. So I'm glad that just kind of randomly came up without us planning that, because it's just so close to what's made us successful, that laser niche approach. And I just want to emphasize that for anyone listening who kind of glossed over and wasn't paying attention, to rewind that and listen really carefully to what you just said. Great. So what is common among all of the top commercial real estate brokers that you've worked with, besides that niche approach of being hyper specialized in one area? What else is common among all the top real estate agents?
In addition to thinking like an owner, I guess it's just really having depth of knowledge of their market. I can give you an anecdotal example. We are in the process of selling a multifamily building in Philadelphia, which we haven't really started, we hadn't really sold a lot in that. We bought a lot and developed a lot, but we hadn't sold yet. And we were working with an agent. I hadn't worked with them before. They came recommended and said everything we wanted to hear. And when we actually went through it and went through the listing, it just sat. And at the end of the day, it was mispriced. The agent was more concerned about getting our business than actually executing on the deal. And that relationship didn't last very long. And when we found the right broker for that property in that market, instead of it having sat for 6 months, it traded in less than 30 days. And so I think those are the kinds of examples of really, again, getting back to the laser focus. Know your market better than everyone else, because like it or not, sales and brokerage is a commoditized business. And if you don't know what your value add is, it almost reminds you of the old anecdote. If you're at a poker game and you don't know who the fool is at the poker, you don't know who the mark is at the poker game, you're the mark.
You're it. Yeah.
Right. Same thing I'd say in real estate. If you don't know what your value added is and you can't explain it to a 12-year-old, you need to go back out there and improve on that value add, because everyone is going to tell you what you want to hear to check the boxes. Right,
for sure. What are some unique methods or strategies that you have for valuing commercial real estate assets?
So we take a very, I would almost say, I don't want to say it's pessimistic. We take a very, very conservative perspective. I'll tell you, a lot of the consulting work we do, because I probably look at 100 deals a week now. We really strip back all the layers of the onion. We really dig into the assumptions. Again, I'm going to pepper you with some other quotes. One of my other favorite quotes, I think it's from Mark Twain. I'm not sure. It goes something like, it's not what you don't know that gets you in trouble. It's what you think you know and ain't so. And so, assumption is the mother of all screw ups. And so we really take a hard look at our assumptions, and then peel back a lot of the noise. And there's always noise on any given deal. Is again, another anecdotal example. I've looked at, projects and offer memorandums where the IRR on a stabilized, tier 1 100-unit multifamily was 22%. And I can tell you, these things don't, quintuple or don't double every 5 years as a matter of general course, right? So again, unless there's something spectacular or development play or something in terms of significant risk or value add, those numbers are inflated, and they can be inflated in any myriad number of ways, which I won't bore you with. but understanding your asset, understanding the risk, parameters. And then thirdly, I'd add to that is we don't have positive exit assumptions. So for example, if we underwrite it and we buy it at a 6 cap, we don't assume we're going to be able to sell it for a higher capitalization rate than where we bought it at. And what that does is it forces us, when we go look at the rest of the numbers, whether it's ROI or IRR, when you have an exit cap that's equal to or less than your insurance cap, it really forces you to look at the cash flows of the property exclusively. And which is why, to answer your question, the last portion of what we do in diligence that may differ is we don't ever assume appreciation. We tend to get it a lot, thankfully. But we need to make sure that the investments can sort of stand on their own purely based on a cash flow, return on a cash or a cash on cash basis with no appreciation or compression of interest rates. And what we find is we usually underpromise and overdeliver, and we're very comfortable with that methodology.
Great. What is the number one lesson or insight you could provide related to commercial real estate valuation, perhaps for somebody who is just new to being a passive or active investor in this space?
Yeah, there's so many. I'll try to come up with one or two that have served me in the last 20 plus years, and that is, I would say, really focusing on the assumptions in the sense that everyone hopes assets go up, and what's hard, I think, is in the last 15 years that they've almost predictably gone up every year. It's again more a function of interest rates than a function of how smart us real estate investors are. Although some investors might tell you differently. We don't drink the Kool-Aid on that. We understand the difference between value add and simply luck in the markets, and they're mutually exclusive. And so when it comes to understanding and pro forma, which has become a dirty word, I think it's this market is incredibly tough to transact in. So the more you understand and the more you get about risk and what may or may not happen, I think the more you can handicap your risk.
Right. Great. How heavy is financial modeling, or how heavy of financial modeling is typical when you're evaluating commercial real estate assets with you and your team?
Yeah. I would say it's fairly moderate. I don't get too impressed by a lot of fancy schmancy Excel programs, or, at the end of the day, and again, I don't think I'm particularly exceptional. When I look at a deal, I can tell you within 5 minutes in the back of a napkin and a calculator whether this thing's going to make sense. Not all deals are like that, and not all deals are that simple. But at the end of the day, the more brain damage and financial engineering I have to get through to understand a transaction, usually what it means is there's something wrong, right? Or there's fraud. And neither one of those are good. And I'm not saying that's the case in everyone. And there are some complex deals we've been involved in, of course, that it was worth the brain damage. But in terms of the model, I don't think what kind of modeling you do is as important as your assumptions. And again, assumptions are the mother of all screw ups. And I've seen assumptions that you're buying in at a 5 cap and you're exiting at a 3 cap. Those just aren't reasonable assumptions in my opinion.
Right. And that ties back to your comment on being laser focused on one area. If you are, then you can make that judgment in 5 minutes. Whereas if you don't know the price per door in the area and you don't know how much rents, then it's going to take you a while to figure out which way is up, obviously. So
absolutely. And to your earlier point, also, the more you specialize in, the smaller the world in which you're specializing in. And I have a colleague of mine who is very similar to what you were mentioning, focusing on 1 or 2 blocks. The added value of that is you're actually making a market. You're becoming the market, right? And that's that having that kind of leverage on an asset you understand. What you'll find is over time, 2-3 deals into it, you won't worry as much because you'll know. And that's why buying stuff that's contiguous, and we're doing a deal right now where we've owned a property for 5 years, we understand it, and the one literally next door came on the market on the water in Fort Lauderdale, and it's a no-brainer for us. We don't have to. We know what we're getting, and that's what you find. It's the learning curve.
Right. Makes sense. What is unique about your commercial property due diligence process?
I think what's unique about us is, again, and this gets back to my comment earlier about brokers thinking like principals. I think there's so many brokers that don't understand their role, and that specifically what I mean is their role is asymmetric. They're taking asymmetric risk. And when I say asymmetric risk, what I mean is they get a commission, regardless of whether this deal is good, bad, or indifferent. Whereas principals, we got to live with this for the duration. And so what I found, and this is true of every broker, not just in commercial real estate, whether it's a stockbroker or any salesperson, they're selling you upside, and that's all well and good. But the way we underwrite things, because again, we're very risk averse and we don't necessarily need home runs. We underwrite 80 to 90% of our time is underwriting the risk first and all the things that can go wrong. And then the return is almost secondary. And so I think focusing on risk more than anything else is really perhaps what differentiates us from most of our competitors.
So I didn't plan to ask this, but since you're so familiar with it and I've been frustrated by it sometimes, what is a commercial real estate broker model that would actually align them with you more? Is there a way that if things go well, they get paid out a double fee, and if the deal is not good or it doesn't work out, they get paid almost nothing, just enough to cover their paperwork, but really they get paid very, very little if it turned out to be a bad deal? Have you found a way to do that, or have you custom structured something with brokers to align them with you in some way?
It's an interesting question. We've tried doing that. And, interestingly, most of the pushback we've gotten is actually from the brokers. And I think, the other sort of filter that we like to use, we don't use it all the time, but on occasion where deals are marginal or where we're bridging a gap, we'll put it to them and say, look, why don't you guys put in some of your equity on the deal, or would you be willing to do that? And it's one thing, I don't expect everyone to put equity on every deal, but if they've never done that and they don't own any commercial real estate and and again, it's not an automatic disqualifier, but it certainly gives me confidence to know that A, they're able to think like an owner, and B, that they are going to think like an owner. And again, I have a group of brokers that I've worked with exclusively, and I know that when they call me, they're not going to waste my time. They're not going to, I'm not going to be able to shoot a bunch of holes in it in 30 seconds because they've learned to think like an owner. And I have to say, it's a lot easier to think like an owner once you're an owner and you have the benefit of the experience and the mistakes and the baptism by fire. Learning from others' mistakes is a very, very difficult skill, and only very few brokers I've seen have been able to master. I don't think I could do it, to be quite honest,
Right.
Without the benefit of that experience. So that's what I'd recommend.
Right. Good point. Okay, great. Where do you see most investors messing up or missing the mark on real estate investment due diligence?
Wow, how much time do you have? I think I'll tell you, I won't go into individual areas. What I'll tell you is I think that the pattern of mistakes is, again, usually falls in the category of either not understanding the asset, not understanding why they want to own it, buy it, invest in it, not understanding or misunderstanding the assumptions. Is one, and again, an anecdotal example. There's so many games being played with debt. I saw one deal where it was, again, an above market return, and it was based on an interest-only debt service payment. And, that's all well and good, but those things only last 1, 2, 3 years at the most. And then you're stuck usually with a 10-year term that's fully amortizing. And so what may have looked good in year 1, 2, 3, by the time you get to year 4, on some deals are actually negative cash flowing. And so I'd be real careful to not just look at the next year or the next 2 years or the next 3 years. Commercial real estate especially is a very, very, very long-term endeavor, as you know, and really our minimum perspective is 10 years.
Right.
And so that's how we tend to look at, that aspect.
Awesome. What legal structures do you use while putting together a real estate investment?
So, obviously LLCs have been our go-to entity, not S&C Corps. They're unnecessary, expensive. And again, most of our stuff is single member LLCs or pass-throughs. That's not only an advantage for liability, it's an advantage for tax reasons. We don't have to deal with double taxation or distributions. So LLCs, SPEs, when we do partnerships, one of the key things, and I have to thank our fantastic legal counsel that sits in DC, who does this, they set up all of our partnerships as tenants in common. Lots of reasons for that, but the simplest ones are, if you ever have an issue where a deal goes south or one needs to buy out the other, or you're both selling, but one wants to do a 1031 and the other partner doesn't, without having that kind of tick structure in place, it can really cause a lot of complications. And so, I would say LLCs, ticks, and then, certainly making sure we operate efficiently and that everything fits into our estate plan for the family.
Right, great. What areas of the tax code are you navigating most often when it comes to structuring real estate investments? Are there 5 to 7 things or 10 things or just 1 or 2 that you're really focused on?
It's really, I'd say 2 or 3. Obviously, we always have a very keen eye on capital gains taxes. Under the Biden plan, which again, appears to be is going to be president. We'll find out soon enough for sure. But it certainly looks like there's going to be some potential tax changes. And again, depending on how the Senate race comes out in Georgia, we may or may not see significant increases that are proposed into the Biden plan on capital gains. We try to run things, and we're very fortunate to be able to run our companies so that even though they're all positively cash flowing, we buy them right and we structure it so that most of them depreciate out. So, anytime I like to joke that anytime we get close to having to pay income taxes on cash flow, we buy another building and add depreciation and reset the clock. And so we tend to keep a very close eye, number one, on capital gains, number two, on income. And I'd say a very important and not too distant third is 1031 and how that fits into estate planning. And so for the other family offices and brokers listening, when you add on all of these layers on top of each other, I don't want to say it's rocket science, but you certainly need a lot of folks smarter than me to properly sort of navigate the difference between, year-to-year taxes, capital gains taxes, 1031, where you're going to be doing with legacy, proceeds and all that. And it's almost as, I would say, is time consuming and as difficult as the actual investing in the real estate. So that's where we're spending quite a bit of time in.
Right. Okay, makes sense. What are the top 3 insights you could share on being an effective commercial real estate investor?
Great questions. The top 3. I'd say the first is to have a very, very long-term perspective and a very long-term time horizon. And I think a lot of people say that. In my experience, even in the commercial real estate industry, not a lot of people actually have that. Or if they have it, they think long-term is 3 to 5 years. What I've found in my time and through a lot of clients we've worked with and advised is, and learned through their mistakes, is that usually the shorter the time horizon people have, the more mistakes they make. Because if you buy it right and you're buying a good market that's stabilized and an asset you understand, and you hold it long enough, right? You can hold it through bad markets and you can hold it through downturns like 08, 09, like we've had recently with COVID. Usually time fixes most of those small mistakes. It won't fix, structural mistakes. And if you're buying obviously an office building in New York, you've got different considerations. But aside from those outliers, having a long time horizon, being just obsessed with risk and downside, and then just making sure you have the right partner, and if you don't, what the right partner looks like. I could spend a whole hour on partners, but in short, I'd say as far as the partnership goes, figuring out what you're good at and what you're not good at, and bringing in a partner that is basically the opposite of you or is able to fill the gaps that you have. In our example, we don't do a ton of marketing. We haven't needed to. So when we've looked at partnerships, partnering with a marketing expert is appealing to us because that's not sort of, that's not what we specialize in. We're number crunchers at heart.
Right. What are some long-term trends that you think most people are ignoring or denying even exist right now, but you think are going to come to be true?
Wow. Again, how much time do you have? There's a lot of them. I'll try to go with some of the bigger ones, and I'll kind of go by asset class, at least the ones we're invested in. I think the scary thing about multifamily, which is probably the strongest out of all the asset classes right now, is really we're just seeing a tremendous amount of capital really flowing out of every other asset class and sort of being siphoned off into multifamily. There's good reasons for that in the sense that the disruptions technologically coming down, which you've heard me talk about probably ad nauseum at this point, they're actually starting to materialize. We were talking earlier about Tesla, which is a wonderful company. I love my Tesla. I remember good friends of mine laughing at me 7 years ago when I bought it, thinking, "Oh, it's just an electric car. I've driven them. They're terrible. They have a 50-mile range and yada yada." And here we go 7 years later, and they're bigger than every other car company in the world put together. That couldn't and wouldn't happen 20 or 30 or 40 years ago. It certainly wasn't happening, when I started out in the late 90s. And so I think the rate of disruption and the rate of change is just getting faster and faster. And so the effect of that, bringing it back to real estate, is commercial multifamily is getting probably overvalued just because there's a lot of fear in every other asset class. Industrials is probably becoming overvalued. Same reason. The rush to internet marketing and sales and not and COVID, I think, accelerated that as well. And then the other asset classes, which are office, hotel, and retail, are going through massive disruption. The office disruption is probably, in my opinion, is the greatest, even though people talk about retail. Retail is a very close second, and then hotels, which hopefully is temporary. I don't know. But though the trends that we're seeing are not going to stop, they're going to accelerate, in my humble opinion. And the rate of disruption across all industries, which will indirectly affect real estate, is going to be significant. So getting ahead of those trends is what we've tried to do and what we continue to try to do with a lot of our.
Makes sense. I mean, I know you're very well connected in different business owner clubs and family office groups. And because I run the family office club and commercialrealestate.com, I see a lot of stuff. And this wasn't a planned question. I'm just curious. But I have the problem you probably have sometimes too, in that you see, oh, everyone's talking about industrial now. And you never want to be the dumb person following the herd. And so I kind of go to the opposite direction of where I see the mob heading. But industrial probably has real legitimate legs to it because of distribution centers and lack of supply there. But how do you deal with that inside of your family office? I know part of your answer might be, well, if you have the goods to add value to something, then it has to be based on that legitimate process of adding value. But how much does that disrupt or make you hesitate when you see an opportunity where you're like, well, since everybody else in every investor club or business club I go to is obsessed with industrial all of a sudden, you know, should I put on the brakes here a little bit or just check myself to make sure I'm not just being swayed by, you know, Wall Street Journal articles, you know?
Completely. No, I completely, I think it's a great question. The answer, I believe, is that it's really easy to sort of follow the crowd. It feels good and it feels safe. And, you know, I've learned the hard way that over time, things that feel really good and safe and popular don't always end very well. Because again, the difference between feeling and you know, crunching the numbers and looking at the data can sometimes lead to different conclusions. And so, you know, having said that, I think the toughest part on going into another asset class, and the only way we've done it, is we're really not going in and doing stuff on spec. So for example, the industrial asset class, which we've expanded into in the last couple of years, the only types of deals we're even considering is a sale leaseback where we have an operating partner already who is best in class or has a track record and they're really great at what they do. And we're solving some kind of operational problem, either liquidity, which is, you know, very common post-COVID. They own the building and they want to do, you know, $2 million of improvements and we'll lease it to them at a 7 or an 8 cap. But they can reinvest that capital into their operating business at a 20 or 30% return, right? So things like that, they really are a win-win where we're not really taking development or speculative risk. Those are the kinds of those are the only kinds of deals we'll execute on new asset classes for the reasons that you alluded to. We're not arrogant enough to think that, you know, 20 years in multifamily makes us experts in industrial. We know it doesn't, and pretending like it does, you know, usually leads to some real bad results.
Right. Okay. What is a commercial real estate offering memorandum?
So I'll tell you what it should be. When I started out, it was a compendium of information and data that was accurate and specific about a specific commercial real estate. And so things like everything you could possibly want to know to make a decision about buying the asset, from, you know, the financials to locations, aerials, traffic counts, demographics, you know, if it's a retail property or store sales. So things, data points that are, I would call them essential to helping not only a purchaser, but also a lender, because, you know, my background is in banking. So what amazes me is there's so many times that I've talked to brokers and they'll put out an offer memorandum and they won't put in a debt quote. And my first question is, you know, guys, 80% of this, as I mentioned earlier, is financed by debt. Have you guys gotten a debt quote? And sometimes they'll have one and not put it on, but more times than not, they wouldn't even bother to going out and getting one. And, you know, so that's sort of an indication to me that I'm dealing with a broker that doesn't know what they're doing, because the only way those deals are getting done are financed. And in many cases, what the broker will find out after I've gone to the trouble to get my debt financing together is that the asset isn't financeable. And so guess what happens if 80% of the structure is supposed to be financed at cheap debt at 2 or 3%, and the banks, for whatever reason, in this scenario, won't finance it? Well, that means that asset isn't getting sold. And so those are the kinds of things and why I say that's what it should be. I've seen some real great ones, and I've seen some ones that are just terrible. So that's what, in my opinion, I think a good offer manager should include.
Sure. After working in real estate for over 20 years now, where exactly are you spending your time now and why?
So, believe it or not, we're spending quite a bit of time in understanding the rate and the areas in which technological disruptions are coming. And you've heard, me talk about this and in my postings. There's a great article in The Economist, which I circulated with some colleagues. I'll be happy to send it to you. I think it would be instructive for a lot of the folks who are watching, because I think the big move, and The Economist hit the nail on the head, is really from tangible asset valuations to intangible assets.
Right.
And to say tangible real estate is obviously tangible. Intangible are things like software,
Right.
the ability.
Airbnb, where being worth more than Marriott is kind of mind-blowing, right?
And if you look at, and the S&P 500 with Tesla being added was instructive. And I didn't know this until I started looking at it the other day after the news came out. 60% of the top 15 companies on the S&P 500, A, weren't around 25 years ago, and B, are mostly leveraged technology. I think by the year 2030, when we're sitting here, in 10 years looking at this, I think it's going to be close to half, if not all of them. And I think the biggest risk we're seeing is on industries where we have tenants that are going to be disrupted significantly by these technological companies. So it's not just Amazon and retail anymore. I have a good colleague of mine that he specializes in automotive properties. And I've been telling him for years, that's not an asset class I want to be investing in, because that model is not only changing, it's being completely disrupted. It's being gutted. So
Right.
If you're in the industry and you own automotive properties or you own bank real estate, it's going to be challenging. And so
Right.
disruption and technological trends are very, very important in our industry today.
Right. That's exactly why we just spent $500,000 buying commercialrealestate.com, is because of our belief in that transformation of things to the digital. So I appreciate you being a sounding board for us as we're growing this platform and doing this interview as part of our effort to try to take advantage of that trend. I know you're very much on top of what's going on there compared to most family offices I know. So appreciate you bringing that up. What is the best way to sell a commercial real estate property very quickly?
It's funny you ask that, because we've had on some, especially tertiary markets, we've had some issues with just buyers not performing. And again, to my previous comment, it was a multifamily asset, and there's been such a dearth of folks moving into that asset class, not only just from other types of real estate, but from all different kinds of industries. And it's a very timely question, because we, at one point on one asset in the tertiary market, just got so frustrated with having our time wasted by buyers who couldn't perform. We ended up going to an auction, and there's a lot of stigma attached to some of the auction sites. 10X, who we used in this case, was we had very, very good execution. Really impressed with a lot of the folks there. I don't think it's for everyone. If you're selling a multifamily property in the middle of Miami, you don't need them.
Right.
But if you're dealing with a more difficult asset to value, or a tertiary market, or a large asset in a tertiary, something that doesn't sort of fit, and people kind of joke about it. A lot of folks didn't know that, and I didn't know, 10X is owned by Google. So when we're talking about disruptive companies, I got a crash course from the Google folks when we did that transaction about how they broker. And let me tell you, it is just like Tesla's changing the way that cars are built and driven and manufactured. I really do believe that companies like Google and 10X are going to completely disrupt the brokerage industry. I think it's already happening.
Yeah, interesting. I'm sure LoopNet and CoStar has their eye on all that stuff going on, because they're the old school gorilla that's been gobbling up things and acquiring people to become more up to the times with apartments.com and LoopNet and other things. But I'm sure they're on each other's radar. So that's interesting.
Yes.
Yeah. Cool. From an investor's perspective, how do you compare investing in residential real estate versus commercial real estate properties?
So completely different animals, completely different skill sets, completely different metrics. I have one colleague of mine owns 900 doors. Every single one of them is a single family. And I tell you, the appreciation is nice, but man, that is, and companies are starting to do that on a very large scale. I think there was just a recent merger. I forget the name of the company. It was owned by Colony at one point, but very large, where they're trading portfolios of 100,000 single family homes between 2 and 300K a door. So if you do it at scale, and if you're large enough, you can run a very nice portfolio. If you're going to be owning less than 10,000 units, which is, I think, the majority of family offices, in my experience, having started out doing residential and having also done multifamily, I think it's much more economically effective and efficient to do large scale multifamily versus single family. The economies of scale just are not there in single family homes. Every time you have to, do a rent, make ready for a home, you're spending 3 to 4x what you'd spend on an apartment. Every home is different. Every yard is different. The tenants are different. The marketing it's completely night and day. Not to say one can't transfer from one to the other. I had not seen a lot of folks successfully do both. And I don't think we successfully do both when we focus on multifamily. But I think the rate of return and a lot of the metrics are different and, quite frankly, more attractive if you're looking to place significant capital. I think multifamily.
Right. Okay. What is the most expensive or painful mistake that you've made in the commercial property investment area that by sharing it, maybe somebody could relatively easily avoid making that same mistake?
I've made a lot. I would say probably the one that sticks out most in my mind is not having the right partner. And we learned the hard way. Partners are great until they're not. And that's why operating really very tight operating agreements where, we don't leave anything to chance. Everything is spelled out in terms of who's some simple stuff that sounds obvious. We want to understand that up front. And we've had cases where we had very tight operating agreements and partners we've approached just, wouldn't sign them. And that was, we found out later that was probably a really good thing. And so I'd say having the right partner, having very tight, good fences make good neighbors. I think it's absolutely true in this business when it comes to partnerships in commercial real estate. Right.
I think it's a really good piece of advice to tell people that hasn't been shared on any other of these interviews. That's great.
Oh, wow.
Final question here. What is a $100,000 value piece of advice you could leave us with here related to commercial real estate?
If I had to pick one, I would say, and again, I think this coincides with longer term trends. I would say outside of, say, multifamily and residential, if you're in commercial real estate in any other asset class other than apartments and single family, and if you haven't thought about it, and if you don't fully understand how your sector is going to be disrupted in the next 5, 10, 15, 20 years, figure it out now. Because by the time everyone else figures it out and it gets priced into the market, you don't want to be owning a portfolio of Kodak and Blockbusters.
Right.
And I think there's a lot of folks that own those and just don't know it yet. And again, I hope I'm wrong, and I hope the market takes off and things change and things stabilize. But I think walking around pretending like, the internet is not going to affect me and I'm in, main location, because at the end of the day, the internet is the online real estate of the future. And
right.
To the point with what you're doing with the family office, I think anyone who's not doing that, and we were guilty of it for anyone who isn't thinking in those terms, it's almost too late. It isn't quite too late yet, but it's getting there. And I would encourage them to think, again, very long-term and about disruptions very, very carefully.
Right. Great. Thank you. Well, I appreciate all your time here today. If anybody wants to connect with Ben on anything they think they could work with him on or collaborate on, whether you're a family office or you own a whole bunch of assets that your family's been sitting on for generations, and you just need some advice or strategic guidance. I know Ben's a savvy family office professional who we've gotten to know well and could probably be helpful to you. So I'm happy to connect you to Ben. Or Ben, do you prefer someone reaching out via LinkedIn or going to a website or something if they want to touch base with you? Or
LinkedIn or email is fine. Again, we do some consulting, and we only really consult with family offices in commercial real estate because, again, we are that hyper-focused, as I mentioned before. So yeah, email is fine. And again, anything to do with operations, getting into the industry, getting out of the industry, partnership issues, and estate planning, that's a good chunk of what we're doing in our consulting arm.
Okay, great. Well, thank you for your time here today, Ben.
Likewise. Thank you for having me.
Thank you. This content was created by commercialrealestate.com. access our community, investment databases, training, and live events by visiting www.commercialrealestate.com.